What if the most dangerous market move in the last 24 hours wasn't the one flashing across headlines, but the one almost no one noticed? While attention stayed fixed on surface-level price action, something far more concerning unfolded quietly underneath. This wasn't a dramatic crash or a sudden plunge. It was a hidden drop subtle enough to ignore, yet powerful enough to cause serious damage if it accelerates. History shows these silent shifts are often the ones that wipe out millions overnight, catching people off guard precisely because they don't look scary at first. In this video, we're pulling back the curtain on what happened over the last day, why it matters far more than it seems, and how these hidden movements have triggered major collapses in the past. The market didn't crash, it weakened. The last 24 hours didn't deliver a dramatic sell-off, and that's exactly why the risk is higher than most people think. Instead of collapsing, the market quietly lost strength. Buyers stepped back, volume thinned, and price support became fragile. This kind of weakening often goes unnoticed because charts don't look alarming, but history shows that markets don't always break loudly. Sometimes they soften first, making it easier for a sudden shock to cause outsized damage later. When strength fades quietly, reactions become slower and exits narrower. This environment is dangerous because it invites overconfidence. People assume stability when, in reality, resilience is already eroding beneath the surface. Liquidity fell without anyone talking about it. One of the most concerning developments in the last 24 hours is the drop in liquidity. Orders are still visible, but depth has thinned. This means prices can move sharply on relatively small pressure. Liquidity doesn't disappear suddenly. It fades quietly, then vanishes when it's needed most. Charts don't reveal this clearly, which is why most investors miss it. Once liquidity dries up, even modest selling can trigger rapid declines. History shows that overnight collapses almost always follow periods of silent illiquidity. The danger isn't selling, it's the absence of buyers willing to step in confidently. That absence is what turns ordinary pullbacks into devastating drops. Confidence slipped before price. Dead confidence is the first thing to break during major market downturns, and it often happens invisibly. Over the last day, sentiment shifted quietly. Participation slowed, conviction weakened, and risk-taking declined. When confidence slips, markets lose their ability to absorb stress. This doesn't show up immediately as falling prices. It shows up as hesitation. Recovery attempts fail faster, and buyers disappear sooner than expected. Charts may look calm, but behavior isn't. History shows that when confidence erodes silently, markets become hypersensitive to bad news. Even a small trigger can cause a chain reaction because belief in stability is already gone before prices reflect it. Leverage is still sitting beneath the surface. Hidden drops become deadly when leverage hasn't fully cleared. The last 24 hours did not remove excess leverage, it exposed it. Many positions remain vulnerable, balanced on thin margins. When prices drift lower instead of crashing, leveraged traders feel temporary relief, not danger. This is where risk builds. A sudden move can trigger automatic liquidations, turning a quiet decline into a violent collapse. History shows that the worst losses often come after people assume leverage has already been flushed out. It hasn't. Until leverage truly resets, markets remain unstable. Silent weakness plus outstanding leverage is one of the most dangerous combinations in any financial system. Artificial intelligence is turning defensive. Behind the scenes, artificial intelligence-driven risk systems have likely already shifted into defensive mode. These systems track liquidity, volatility, and correlation changes faster than human traders can react. When artificial intelligence models sense instability, they reduce exposure immediately. This doesn't cause price drops directly, but it removes support gradually. Over the last 24 hours, subtle structural signals suggest increased caution among automated systems. When machines pull back quietly, recoveries lose momentum. This creates an imbalance where optimism remains high, but market support weakens. Artificial intelligence doesn't wait for panic, it responds to risk. When it turns cautious, markets often struggle to regain strength quickly. Correlations started moving together. A key warning sign in hidden drops is rising correlation, and that's exactly what began unfolding. Assets that normally behave independently started moving in the same direction. This is dangerous because diversification stops working when correlations rise. Investors feel protected until everything drops together. Charts don't highlight this clearly, especially over short time frames. History shows that when correlations quietly increase, markets are entering a fragile phase. Selling pressure spreads faster, and safe exits become harder to find. Correlation spikes aren't dramatic, but they are deadly when ignored. They signal that fear is beginning to unify behavior across the market. Institutions reduced risk without announcing it. Institutions rarely make noise when they step back. They just do it. Over the last 24 hours, signs suggest subtle risk reduction rather than aggressive selling. Positions are trimmed, exposure tightened, and capital preserved. This behavior doesn't cause immediate crashes, but it weakens market structure. Prices may hold temporarily, giving a false sense of security. Retail investors often interpret this as consolidation, not realizing support is quietly disappearing. History shows that when institutions reduce exposure silently, markets lose resilience. The danger comes later, when selling pressure appears and there's no institutional strength left to absorb it. Recovery attempts are losing energy fast. One of the clearest signals of hidden trouble is how weak recent recovery attempts have been. Over the last 24 hours, rebounds stalled quickly and lacked follow-through. This isn't random, it reflects fading conviction. Buyers aren't stepping in aggressively, they're testing cautiously. When recoveries fail early, it suggests the market doesn't trust its own stability. Charts may show small bounces, but the energy behind them is missing. History shows that strong markets rebound decisively. Weak markets hesitate. These fragile recoveries often precede sharp drops because they exhaust buyers without restoring confidence. Time is compressing risk. The most dangerous aspect of hidden drops is how they compress time. Risk builds quietly, then releases suddenly. Over the last day, multiple small warning signs aligned: liquidity, confidence, leverage, and correlation. Individually, they seem manageable. Together, they create conditions for overnight damage. History shows that collapses don't require long preparation once structure weakens. They need a trigger, and triggers are unpredictable. This compression of risk is why overnight moves can wipe out millions. The market doesn't fall because of one event. It falls because conditions made it vulnerable to any event. Media is focused on the wrong metrics. Most commentary in the last 24 hours focused on price stability and surface-level indicators. This misses the real story. Media explains what happened, not what's forming. Structural shifts don't create clickable headlines, but they determine outcomes. Liquidity thinning, confidence erosion, and institutional behavior rarely get attention until it's too late. Charts plus headlines create a false sense of clarity. History shows that the most damaging moves happen when attention is elsewhere. Understanding this gap between visibility and reality is critical. Markets don't break where everyone is watching. They break where no one is looking. Retail optimism is holding the floor. For now, retail participation often increases during quiet pullbacks, and that appears to be happening now. Lower prices feel like opportunity, not danger. This optimism provides temporary support, but it's unstable. When recoveries fail, these positions become future selling pressure. History shows that this phase feels calm before it turns chaotic. Retail optimism delays declines, but it also deepens them later. Charts don't distinguish between strong support and hopeful support. When optimism fades, exits become crowded quickly. This is why hidden drops are so dangerous. They lure people in just before conditions deteriorate rapidly. The real risk isn't today, it's what comes overnight. The last 24 hours didn't deliver disaster, but they laid the groundwork for it. History shows that when markets weaken quietly, the biggest damage often happens outside regular attention, overnight, or during low liquidity periods. That's when reactions are slow and protection fails. The real risk isn't visible on today's chart. It's embedded in conditions that make sudden moves more likely. This doesn't guarantee a collapse, but it dramatically increases vulnerability. Understanding this helps shift focus from prediction to preparation. Markets don't warn loudly before wiping out capital. They whisper. Hidden drops are the most dangerous because they feel harmless until they aren't. What unfolded over the last 24 hours shows familiar warning signs from past market collapses: thinning liquidity, weakening confidence, unresolved leverage, and quiet risk reduction. This doesn't mean panic, it means awareness. Markets punish those who ignore structure and reward those who respect it. If this breakdown helped you see beyond the charts, support the channel by liking, sharing, and subscribing. Leave a comment with your thoughts. Conversations like these help others stay informed. Stay alert, stay disciplined, and stay ready, because the biggest moves often come when most people are asleep.